Hello and welcome to a short update from the CABA Capital. My name is Anders and I want to spend a couple of minutes on the apparent disconnect between the geopolitical risk environment and the current pricing in credit and equity markets. The lens through which we are all looking at this right now is of course the blockade of the Strait of Hormuz. If we look at equities first, we have US indices at record highs with forward price earnings high above the long-term average. This is despite the likely increases in future inflation and despite the shortfall in the physical oil and gas markets. The picture in credit markets is similar. US and European credit spreads are close to cycle lows across high yield and investment grade. The current short-term risks in relation to energy supplies are well understood. But what are the longer-term drivers that the market is focusing? Two things are key: continued increases in actual earnings and expected gains in productivity from investments in AI. The pricing is therefore not necessarily wrong, but it does rely on financing remaining available and on inflation remaining under control. That is a sensible long-term view, but it leaves little margin for error if those assumptions start to change. Alternative investments with limited beta exposure should therefore remain a key component of investment portfolios. For CABA Capital, we are pleased to report that our investment case is still performing as expected. Flex 2 and Flex 3 have provided return of 10 and 14% respectively since the inception of CABA Flex 3 in June last year. As always, if you would like to hear more about CABA's investment case, then please get in touch. Thank you for listening.